Alison, initial thoughts as we're trying to parse through this.
There's a lot to this.
Comes out,
really
Yeah, so the big number, as you said, fixed income trading, they do earn more from that than most of their global peers. That came in better than expected. Equities trading looks pretty light, and I'm going to guess that also relates to Steinhoff. We did see JP Morgan take that charge in their quarter. As we know, Citigroup also had some involvement, so that's my guess is that also reflects the charge. Efficiency ratio, that's something that is very important for Citigroup, came in at 58%. They had actually telegraphed they thought it might come in a little bit higher than their goal for the quarter, just due to the weaker trading, so that is a positive. And I don't see the card losses yet, but that's the other thing that I'm.
Well, they said the cost of credit
Right.
was about $2.1 billion, and they did see an increase in net credit losses, David, of $184 million through that volume growth.
That cost of credit is up 16%, it says here. So they are taking more reserves.
And we do see the episodic charge off in ICJ, so that also is the Steinhoff that we just spoke about.
Wait, say that one more time?
So they took they called it an episodic charge in ICJ.
Is that a technical term for banks?
So I think it is a technical term. And
that's a Steinhoff thing.
And that's a Steinhoff, but I think people were anticipating that, and I think, again, the trading coming in better than expected, the cost coming in better than expected. I would call the tax reform charge right in line. I don't see any guidance yet on the tax rate, but I think that's another thing that.
No, but Michael Corbett, the CEO, was very careful to say we're going to be returning a lot of capital.
Right.
In fact, we're going to stay on the $60 billion return, and tax reform not only leads to higher net income and increased returns, but also serves to strengthen our capital generation capabilities going forward. So that's a message to the street. We're going to be returning more of your capital to you, shareholders.
Right, and I think that people have been anticipating this charge basically since the election. It was the only stock in the red sort of the Friday after the election. So I think people have been long anticipating the charge. But the bottom line is it's not going to affect capital return. They've talked about returning $60 billion over the next few years. They said in December that this charge is not going to stop that. And at the end of the day, to the extent that their ongoing earnings are going to be lifted by tax reform, that should translate into more dollars since they have already sort of moved towards this higher payout rate. I
should point out, too, that loans were up 7% year on year. Deposits were up 3% year on year. Is that the same kind of mix? JP Morgan loans were up, I think, 6%, right?
Well, Citi's a bit different than the other banks because they are more credit card focused. And, we did see very good holiday spending in the quarter. So that's going to increase their loans, even if it's spending that the consumers will pay off in January. It's going to increase balances in December. So we don't quite know how much of that is due to spending. They did talk about last quarter having a higher mix of transactors and teaser balances. So I guess we'll want to see if that's contributing to the loan growth again this quarter.